I am so excited about this video. This is the culmination of over a month of research. If you're new here, hi, I'm David, and I'm the founder of Flank Investing, which aims to make intelligent investing more fun, social, and accessible. Instead of taking the talking head approach, I created a public portfolio where I show you how I'm investing $100,000 of my own money. Before this video, I had about $5,000 in Disney and about $95,000 in short-term bonds. I used short-term bonds as a way to fight inflation while I searched for the company I wanted to buy. Disney's performed pretty well since I took my position back in November. It's up about 30%, and I like the direction the company is heading, and so I added to the position, where I'm now about $10,000. And I just took a bold new position in Lululemon, about $30,000 worth of the stock. I've been researching Lululemon for about a month now. It's a company that I've liked for a really long time. I love their clothing, as you can tell by the fact that I've unintentionally worn Lulu in about every video I've made. And I've been attracted to the business itself based on their high margins and incredible growth rate over the past years. I just haven't taken a position in the company because I thought it was a little too expensive. Fast forward to a few weeks ago, Christmas came early and the stock got pummeled based off of a weak forecast from management. So I sharpened my pencil and dove deep into the research. Along the way, we've made videos on each step of the Buffett style investing framework. This is the final step in that framework: valuation, and then my investing thesis. If you'd like to see how to conduct the other steps of the investing process, feel free to check out these videos. You'll want to start with this one, which covers understanding the business and checking for financial health. Then you'll want to move on to this one, which covers analyzing for an economic moat, both qualitatively and quantitatively. And then you'll want to move on to this one, which covers how to evaluate a company's management. Okay, on to valuation. Valuation can go really deep. A side quest that I went on in my own investing journey is that I got to the point where I thought that through intense study, I could find the perfect valuation technique that could get me a penny accurate valuation of the company I was studying. I spent hundreds of hours trying to find this holy grail valuation technique, including reading this book and this wonderful book. What I learned from reading those books is that there's no holy grail valuation technique, and it left out a major point about investing. It's a science, but it's also an art. I was ignoring the latter. Hardcore quantitative modeling isn't how Buffett does his research. He has a famous quote where he says, "Read Ben Graham and Phil Fisher. Read annual reports, but don't do equations with the Greek letters in them." This also makes sure that we're keeping our advantages as individual investors. There's no way we will be able to build a better quantitative model than the professionals, but we can focus on a much longer length investing horizon than they can, which is why we're such strong proponents of the Buffett style investing framework. It helps us capitalize on our very few advantages. That's not to say valuation is a fool's errand. Outlaying the future cash flows and discounting them to present value is a great way to approximate a company's intrinsic value. It definitely helps anchor our analysis and keeps us rooted in reality. Here's Buffett.
But the real question is, Berkshire's selling for, we'll say, 105 or so billion now. What can we distribute from that 100? If you're going to buy the whole company for 105 billion now, can we distribute enough cash to you soon enough to make it sensible at present interest rates to lay out that cash now? And that's what it gets down to. And if you can't answer that question, you can't buy the stock. You can gamble in the stock if you want to.
And so in this video, we'll cover 3 separate valuation techniques, and then I'll blend all 3 of them to see what I think the fair value of Lululemon is. Again, investing is an art and a science. Be sure to stick around until the end while I'll give my final assessment of Lulu's fair value and my investing thesis. There is so much to cover in this video, let's get after it. The first valuation method we'll cover is called the 10 cap valuation. This approach, made popular in real estate investing, proves to be equally insightful for analyzing deep value stocks and assessing a company's value. Here's how it works. The heart of the 10 cap valuation lies in a metric called the capitalization rate, which is calculated simply by dividing owner's earnings by the current market value. But what exactly are owner's earnings? It's a metric that Warren Buffett came up with in his 1986 annual report. Think of it as the cash that could be theoretically pocketed by a business's owner each year. It's akin to free cash flow, yet distinct in a few crucial aspects that we won't cover here. Just know that calculating it is kind of a pain in the ass, which is why we're going to automate it in the platform we're building. Using the 10 cap method to determine a company's valuation is very straightforward. You simply multiply the owner's earnings by 10. This will suggest a 10% return on investment. If you're targeting a 20% return on investment, multiply the owner's earnings by 5 to get a fair valuation. And if you want a 5% return, multiply by 20. Lululemon's owner's earnings for 2024 were $2.1 billion. If we aim for a 10% annual return, the maximum market cap we'd be willing to pay is $21 billion. For a more ambitious 20% return, we'd look at a $10.5 billion valuation. And if we want a more conservative 5% return, it'd be around $42 billion. This model doesn't include a margin of safety, as it's inherently more conservative, and one of the downsides is it doesn't account for future earnings growth. It is quite rare that we hit a 10 cap. This is more of a deep value analysis because we're not taking into account Lululemon growing their earnings in the future. Which brings us to our second valuation technique, the discount cash flow analysis. This is probably the most common type of valuation in all of finance. To best visualize why discount cash flow analysis works, imagine you're evaluating a company as if it were a simple machine that just prints money. If this machine consistently increases its cash output, that's a promising sign. Conversely, even if the output of that machine is declining, that machine might be a worthwhile purchase at the right price. It all boils down to determining what you'd be willing to pay for these future cash flows, considering both the increase or decrease in production. Here's an example. Let's pretend Apple is a money printing machine. Based on its market capitalization, you could buy it right now for $2.6 trillion. If the Apple money machine was only printing $1 million a year, would you buy it for $2.6 trillion? Probably not. If that Apple money machine was printing $2 trillion a year, would you buy it? Yeah, of course. You'd make your money back in about a year. But if that machine was printing $100 billion a year, would you buy it? Well, that's a little trickier. The biggest thing to think about is how much that money printing machine is printing now versus how much it will be able to print in 10 years. And then how much will we be able to sell that machine for in those 10 years? This is also known as the terminal value. So to actually get into the numbers, we'll start at the owner's earnings just like we did in the last step. And then we'll take a look at what rate the company is growing in order to predict where owner's earnings will be in 10 years. And this is one of the faults of discount cash flow analysis. I can use any growth rate I want, and that will spit out any fair value that I want. For instance, I could assume that Lululemon will grow at 50% the next year. It's done it before, and this would make it look cheap at basically any price. So I like to do a couple of ranges. The stock recently got hammered over their next quarter predictions on growth, where they reported a 10% expected growth rate. Given their 10, 5, and 1 year revenue growth rates of about 18% and free cash flow equity growth rates way higher, I'll give a mid-range of 18%, and then I'll use 25% growth rate as my max range. This still has some safety built into it because the company has grown at about 30% for the past 5 years. Although at their current scale, this will be very hard, if not impossible. But over 80% of their revenue comes from the United States, and given their quick expansion into other parts of the world, namely mainland China, and other innovations, a 25% growth rate isn't insane. So if we take last year's owner's earnings and then multiply it times 1 plus that growth rate for the next 10 years, we can see at a 10% growth rate, they'll have $5.5 billion a year in owner's earnings. But if they grow at 18%, then it'll be $11 billion in owner's earnings. And at 25%, it'll be $19 billion in owner's earnings. Compounding is such a powerful force. For context, Nike's operating cash flow last year was $5.8 billion. So these numbers aren't insane. An 18% growth rate would be pretty impressive for Lululemon, but it's not impossible given the fact that they charge more for their products. Okay, so now we think about what will I be able to sell Lululemon for in 10 years? If I look at their historical price to free cash flow, then I can see what the market has historically been willing to pay for Lululemon's free cash flow. Of course, we're using owner's earnings here, but this will give us a general sense of the direction we're going. As we said before, free cash flow and owner's earnings aren't too different. Their historic price to free cash flow has varied a lot, from 25 to 572, but back then they didn't have a lot of free cash flow, but were growing like wildfire, so the market was willing to pay a little bit more for their earnings. The current price to free cash flow is at 25.9, but for the past 5 years it has been 35, 119, 43, 74, and 81. Let's be conservative and look at a more mature company like Nike, which has sat between 22 and 95. Given all this data, I think that 25 is a pretty conservative price to free cash flow valuation in 10 years. Okay, at that growth rate, and then for that multiple at the end of those 10 years, I should be able to sell Lululemon for $136 billion if it grows at 10%, $275 billion if it grows at 18%, and a whopping $489 billion if it grew at 25% year over year. If that doesn't seem reasonable, you're not crazy. We've intentionally ignored the discounted part of discount future cash flow, which means that a dollar today is way more valuable to us than a dollar in the future. This is the second flaw in discount cash flow analysis. You can choose any discount rate that you want. Some analysts will use a discount rate based on opportunity costs or a risk-free rate, or even what their minimum ROI is. As you can see, discount cash flow analysis varies widely. Since my cash is otherwise sitting with those government bonds that currently yields around 5%, I'm going to use that as my opportunity cost. And so I'm going to discount those future cash flows at a 5% rate. And so to do this, we'll rerun those future cash flows, but then discount them using this equation. So now that we discounted those future earnings at 5%, we then add up the outlays of all those future cash flows to get our final valuation. Added together, at a 10% growth rate, those future earnings are worth $27 billion, $42 billion at an 18% growth rate, and then $62 billion at that whopping 25% growth rate. And so those numbers don't seem too crazy or too far out of Lululemon's historic valuation. The company is currently around $40 billion. Now onto the third valuation technique. This approach comes pretty much right out of Phil Town's rule number 1 investing. In this one, we'll look at earnings per share growth instead of Buffett's owner's earnings. And then we'll take a look at what that future PE ratio will be to see what that price will be and then discount it to get that net present value, just like we did in discount cash flow. So Lulu's most recent earnings per share was 12.2. I assumed 3 growth rates just like we did before, a conservative 10% growth rate, and then a 25% more aligned, and then the mega bullish case of 35%. The reason why I used a higher one is because we're only looking at 5 years here as opposed to 10 years. It'll be easier for the company to grow quicker over 5 years than it would be over 10 years. You then take that share price and multiply it by the expected PE ratio you could sell that company for in 5 years. Again, I'm going to be conservative here and say that I'd be able to sell it for 26 times the current multiple. Although historically it's traded well above that. This means that as sales slow down, due to the law of big numbers, the fair market value will be earning less and less. This is natural. So we multiply that terminal value by earnings per share in 5 years times the expected PE ratio of that sale. This gives me a pre-discounted share price of 510 for my min case, 968 for my mid case, and $1,422 for my max case. This looks all great. Now I want to discount this at my minimum ROI of 15%. This gives me a pre-margin of safety value of $253 per share, $481 a share, or $700 a share. Its current share price is around $336 at the time of this video. But again, this is excluding the margin of safety, which we'll cover now. At the top of the video, I talked about how it's impossible to get that to the penny exact valuation. We never want to pay what we think the intrinsic value of the business is. This is because it doesn't include any margin of error. And so after my valuation, I will apply a margin of safety to account for the inevitable bumps in the road that I can't see. So to recap all of those valuations, at the 10 cap valuation, we have either a $10 billion, $21 billion, or $42 billion valuation based on our expected ROI. And then our discount cash flow analysis yielded a $27 billion, $42 billion, and a $62 billion based on a 10, 18, and 25% growth rate. And then our discount earnings analysis gave us a $48 billion, $68 billion, and $91 billion valuation. Again, these are without a margin of safety. I actually think that I'm going to use an aggressive growth rate. I really do believe that Lululemon is capable of growing at about 25% per year for the next 5 years, and perhaps even the next 10 years. If we look at historic growth rates, this isn't crazy, and would actually represent a slowdown. So, use my discount cash flow analysis and my discount earning analysis of 25% growth and then splitting the difference. That puts my pre-margin of safety value at around $80 billion. I want to use a 30% margin of safety, which puts my fair value estimate of Lululemon currently at $56 billion or $463 per share. So I got my fair value of Lululemon for $56 billion. We gave a lot of information in a pretty short order, but let's move on to the investing thesis. This represents why I bought the stock and will help me look back as the years go on to see if my thesis will change. First and foremost, I love the product. I pretty much wear Lulu anytime I shoot a video, and that wasn't intentional. It's just what I wear when I work from home. I think that they have an attractive growth story based on their brand moat and the staying effects of athleisure. I don't think athleisure is necessarily going anywhere anytime soon. But with Lululemon's diverse offerings and their history of being able to pivot in and out of styles, I believe that the company will be able to continue to create best-in-class clothing, as demonstrated by their existing offerings of business casual clothing. As they talk about in their annual report, overseas growth will be a major growth factor for the company, specifically in mainland China, which represents about 10% of sales, and the rest of the world accounts for another 10% of sales. I expect to see these numbers grow at a 50% year-over-year rate. Continuing to grow their men's clothing option can also be a significant new source of revenue. I expect men's fashion to account for about 45% of their revenue in the future. Finally, the company's push into footwear can also be a baseline offering to continue to help the company grow. They also have some moonshot capabilities. Although they are pivoting out of their in-home tech offerings, and I think a strong acquisition target could be Peloton. This would help increase brand awareness as the Peloton instructors have a cult-like following, as well as give the company a recurring revenue model. But outside of their core business operations, I'm bullish on the company based on the insider buying activity, the CEO's career of performance in creating vigorous, global, and youthful brands, as seen with his work at Sephora. And finally, they are doing some financial engineering. The board seems to be pretty keen on approving share buyback programs that will help give the company some padding if this growth story doesn't work out exactly how I plan it to. Speaking of if the growth story doesn't work out how I think it will, I think it's important to also steelman your thesis. So this is the potential risks of my thesis. In their annual report, they call out that growth in China is going to be a majority of where their store operating buildings are going to go in the coming years. So deteriorating relationships with China and the US could have a material impact on their business. Second, I just finished the documentary Brandy Hellville, and I think our generation is getting kind of tired of not knowing whether or not the clothes that they are buying are sourced ethically. With the price that Lululemon sells their clothes at, there should be no question that those clothes are sourced ethically. Speaking of which, we're seeing direct from manufacturer labels. In the annual report, Lululemon specifically calls out that they have no patents on the material or the fabric that they sell, which means that other people could come in and replicate. There are also other brands coming up that could eat away at Lulu's market dominance, namely the Kardashian-Jenner-backed Alo Yoga and Vuori. The former, Alo Yoga, seems pretty hard-pressed to disrupt. They are building stores as sanctuaries, complete with matcha on tap and fitness classes. And per the Wall Street Journal, Alo is building more than a brand. It's selling a complete lifestyle. In 2022, the company reportedly earned $1 billion in sales. I'd like to see Lululemon do this, especially doubling down on their influencer partnerships, either through one-off deals or by an outright acquisition of Peloton, which comes with a host of instructors that have millions of followers on social media. But all these risk factors don't take away from the fact that I think that there's still a lot the company can do. That's all for this video. I know that was a ton of information. We tried to distill this video down as much as possible, but this does represent weeks of research. We started with understanding the business and checking for financial health. Then I assessed for economic moat or durable competitive advantage. We then tested for that quantitatively and qualitatively. Then we evaluated management, and then we gave a valuation. It's a simple process, but it's not easy. This is my thesis, and I don't think anyone should buy or sell based off of my thesis. And this isn't me just covering my ass against a financial advice disclaimer. I genuinely think that taking stock tips is a bad way to invest. However, understanding the hows and the whys of a thesis and then doing your own due diligence is a great way to minimize your risk, and making it social will help remove blind spots. And that's why we're building Flank, so it's easier and more enjoyable to write and share analysis, so we can become better investors together. I really hope you liked this video. Please like and subscribe if you did. We'll see you next time.